Welcome to the Broken Pie Chart Podcast, episode number 52. I'm your host, Derek Moore, and today we're going to take a couple minutes, pretty much the whole show, to go over a few things that people have been asking about lately. And one of them is, anytime you watch the financial news networks, they always throw out these terms about multiples. Do multiples expand? Do profit margins expand? What makes up the earnings per share? When you hear about an earnings recession or an earnings expansion, and they say, well, margins increased, revenue increased, and share buybacks, how do those all work? There's a couple terms that always come up. And so we'll go through these. And then I also want to get into the whole idea of, a lot of times people look at value stocks versus growth stocks, and value has underperformed, I believe, since, 2008. And it's somewhat of a historical underperformance from what I understand when people look at it versus times back in, the early, I guess it goes back to, 20s or 30s, 40s, when value underperformed. But one of the interesting things we'll take a look at, we'll pull out two growth stocks and we'll look at how they traded on a forward basis, and that will make more sense. And it sort of begs the question, is growth outperforming value because growth actually lived up to the value, or should they have been value stocks on a forward basis? So the first thing that we'll get into is the whole idea of market cap and price to earnings ratio. And this will be sort of the foundation. And from here, we'll sort of look at how an investor could see their stock go up or down. But really, when thinking about going up, you could see the multiple expand, meaning it traded at a higher rate versus earnings. You could also see the multiple stay the same, and you can see the earnings go up. And so just to kind of lay the foundation, we talk about market cap. Market cap's one of those things where it's thrown around, hey, what's the market cap? It's simply the number of shares outstanding on a stock times its price that it's trading at. And so really simple example, if you've got 1 million shares outstanding and the stock's trading at $100, we would say 1 million times 100, it would have a $100 million market cap. To give you an idea of just how high some of these market caps go, Apple, Microsoft, trying to think who else, their market caps are around $1 trillion. So that's taking the number of shares outstanding times the price. So market cap is simply looking at the number of shares times the price. And so our little simple example, we'd have a stock with a market cap of $100 million. When we start to look at multiples, essentially what you're doing is you're taking a look at the market cap and seeing how many times or X number of times that stock is trading above its current, looking at the last 4 quarters in earnings. So let's imagine that our example, we have $10 million in net income. And we're not going to break this down to the share level just yet. Often you hear, hey, they earned $1 per share or $2 per share. But for now, just keep it on the the gross or the number itself. So let's say this company has $10 million in net income. Well, we know our market cap is $100 million. We know we've made $10 million in net income. So to try and figure out the ratio, the price to the earnings, we would take the market cap of $100 million divided by 10 million. What we find is we're trading at 10 times earnings, right? 10 times 10 million is 100 million. And so that's the way that you figure that out. And sometimes it confuses people because you can do this at the market cap level and the net income level. But the other way that people do it, and by the way, that would be your PE ratio, the price to earnings ratio, which is simply the market cap divided by the net income. But you could also break this down on a per share basis and then do the calculation. And so in that calculation, we've got the million shares, we've got the 10 million in net income. To get the earnings per share or the EPS, we would take that 10 million divided by 1 million, and we would come up with $10 per share. And then to get the per share, let's say the PE ratio that way, we would take the share price divided by the earnings per share. So here would be $100 divided by 10, and guess what? You still get the 10 PE. So sometimes that confuses people, but it's a difference of doing the extra step and breaking it down to the per share data. But honestly, you can use the market cap divided by the net income, and that's sort of the same thing. So a lot of times what happens is you'll hear people on TV talk about these multiples, and they look at multiples on a trailing earnings basis. And a trailing earnings basis is really just looking and saying, hey, what's the last 4 quarters? Or if you're at the end of a full fiscal year, what's the last year? What did it give you from the numbers? And that's a trailing basis. You'll also hear about valuations going forward. And what are valuations going forward? Well, that's using analyst estimates. So the trailing PE is what has happened. It's what's been recorded in net income, and it's looking at the current market cap of the company. On a forward basis, it looks at the analyst estimates for the next 4 quarters and then uses that as the net income, the estimate of net income, and it looks at how many times forward estimates a company is trading. But we'll get to that. But for now, we think about the multiples, and there's really 2 different things that can happen. You can have a multiple increase, thus increasing the share price, or the multiple stays constant, but net income rises. Of course, these things can fall too, but for now, we'll think about how an investor sees their stock go up. And really, those are the kind of the 2 main ways, right? So let's look at an example. Let's say the multiple expands. They didn't earn anything more. Their net income stays the same, but the multiple expands. And what that means is, instead of, in our example, trading at 10 times current earnings, the last 4 quarters, let's say the multiple goes from 10 to 20. And what that means is, instead of trading at 10 times last year's or trailing 4 quarters net income, you're now trading at 20 times. And if that happens, that would mean the PE goes to 20. And so what does that mean for the stock price? Well, remember, our stock price was 100. Our market cap was 100 million, and our net income was 10 million. And so at 10 times earnings, it's a share price of 100. If we go to 20x, if we go to a PE of 20, meaning the multiple expands, but that 10 million stays the same, that would imply a market cap of 200 million. And on a per share basis, the stock would go from 100 to 200. So that's an example of where a stock's multiple increases. Of course, if it decreases, if it goes below what it was, you would see the share price go down. But earnings didn't do anything. They just stayed the same. The other way, and this is, I'm sort of making some, trying to simplify this for everybody. But the other way, the earnings grow, but the multiple stays the same. So whatever the earnings are, let's say you're still trading at 10x or 10 times those earnings. What happens? Well, let's say our net income went from 10 million to 20 million. So we're earning now $20 per share. Remember that million shares outstanding. And so we had a PE of 10 times, and we're saying the multiple is going to be the same. So we're going to stick at that 10 times PE. Well, to figure this out, to figure out what our market cap will be, if we earn 20 million and we're still trading at 10 times that, well, our market cap goes to 200 million, or we're looking at, $20 EPS, right? And so the earnings the earnings increased, they doubled, but the multiple stays the same and the stock still doubles. Why? Because we're still trading at 10 times our earnings, but the earnings increased, the multiple did not. And so if you think about it, you could get a combination where the PE goes up, the multiple goes up, and the stock goes up. You could also have the multiple stay the same, but earnings grow, and then you could see that. And so when you hear people talking about, I think there's going to be multiple expansion, that means it's going to trade at a higher PE. That's a really fancy way of saying it. Or I think profits are going to rise, but I think the multiple is going to stay the same. Essentially what they're telling you is that the stock is still going to rate or still going to trade at a certain amount times past earnings, but because the earnings grow. So we mentioned we've got this trailing PE. Normally, when you see the PE ratio or the PEs or multiples, they're on a trailing basis. It just means what's been reported, and sometimes it's, as I said, the whole year. Sometimes it just looks at the last 4 quarters. And so you could have a combination of years. But trailing PE versus forward PE, remember in our example, we had 1 million shares, 10 million in net income. Our PE was 10, our stock price was 100, our market cap is 100 million. We've gone over how to do that. But let's say we've got those 1 million shares, and the last 4 quarters, what was reported was 10 million in net income. Let's say the analyst forecast over the next 4 quarters or next year, 30 million in net income. And so if the stock is trading at $100, and now instead of 10 million, which meant it had a trailing PE of 10, now the estimates are 30 million. It has a forward 1-year PE of 3.33, kind of rounded up. And so basically it's just looking at how many times estimated, and estimates are estimates, right? But how many times estimated earnings is it actually trading at? And so, by the way, this can look at, we can look at individual stocks. You can also look at this on the overall market. And that's something that, as we get to the year end, you're hearing a lot of firms, especially at the end of the decade, you're hearing them say, trying to forecast, hey, on a forward basis, what do we think the average annualized return will be based upon how many times forward earnings that we're trading right now? So that's something you'll start to hear from. And, as I said, the S&P 500 index, which of course is roughly 500 stocks, we've got, there's Alphabet A and B, Google A and B, right? But the S&P has a collective sort of PE ratio, and that's the last 4 quarters. The forward PE is the estimates by the analysts for the next 4 quarters. And when we look at earnings, there's a few things that can impact earnings. So we think about, company A had earnings last year of X, or the S&P 500 index is reporting collectively all its earnings. And so there's a few things that can happen. We talked about multiples, but there's also different attributes that can affect the earnings for both, collective indexes and individual companies. And a lot of times we look at this in the form of revenue, in margins, and in buybacks. So buybacks are somewhat of a quasi-dividend because you can have a return of capital in the form of a dividend, but you could also, they could take some of the free cash flow and use that to buy back shares. And some people call that augmented dividends or total augmented, investor yield, which is buybacks plus dividends. But it's another way of sort of returning capital, but doesn't create a taxable event per se, like a dividend would be. And there's some people who, rail against buybacks, but really it is a way to retire shares. And here's how it helps investors. So say in our example, sticking with the 1 million shares, the company bought back 100,000 shares. And so their float went from 1 million to 900,000 shares. Let's imagine all else is equal, and it never is, right? But let's imagine for a second we still have, after the buyback, that same 10 million in earnings. What we would do is instead of earning, 10 million on 1 million shares, which is $10 per share, now we would earn 10 million on 900,000 shares, which is $11.11 per share. And that's just over 11% increase in earnings per share just from buybacks. And so that's one of the attributes that can actually increase earnings. And so if companies are buying back their shares, there's less shares, so there's they get the opposite of being diluted, and so the shares that are remaining, all else equal, get to have more per share attribution from the earnings. Of course, if a company issues more shares, let's say they went from 1 million to 2 million shares, and still have that same 10 million in revenue, well, instead of $10 per share, they would only have $5 per share in net income, and so that would dilute the float. But buybacks are certainly one of the ways. The other is margins. And so we look at, let's say we do something simple like a net profit margin, which is figured by taking the net income of a company divided by the revenue, and then you multiply it by 100 to get the profit, the percent profit margin. And revenue, by the way, is, you can look at this as a more complicated thing. But revenue is essentially, what you've brought in revenue, right? But it's your gross revenue. It's before excluding or subtracting the cost of your goods sold, any of the operating expenses, other types of expenses, interest and taxes, all that type of stuff, which goes down to your net income, right? But let's say you have $100 million in revenue and $10 million in net income. Well, to figure out our net profit margin, what would we do? Well, we'd say, let's take the $10 or the 10 million divided by 100 million times 100. We would say we'd have a 10% net profit margin. And essentially the way to look at that is, every time we sell something, we make 10% net profit margin on that. So let's say that margins doubled. So we had 10 million in net income. Let's say that they created a way to a company reduces their cost of goods sold or their operating expenses. They refinance things, or there's some tax cut, or a combination of all of the above. And they get super efficient. And what they do is, let's say margins go from a 10% net profit margin to a 20% net profit margin. And essentially, let's say they have that same $100 million in revenue, but now with a 20% net profit margin, instead of only earning 10 million, basically their revenue doubles and goes to 20 million. And so now 20 million divided by 100 million times 100 is 20% net profit margin. And so we talked about buybacks could be an attribution to earnings per share growth or subtraction, right? But margins increasing or decreasing can also be an attribution effect to earnings. And so you'd like to see margins, go higher, getting a higher net profit margin. And so net profit margin and shares, all those types of things. Well, okay, so here's the other thing too. You could increase revenue. So let's say that your profit margin stayed the same, but revenue increased to $200 million from $100 million, and we still stayed at that 10% profit margin. Well, in that case, if we're making 10% on the 200 million, we're making 20 million. So our net income doubled from 10 to 20. We kept the same profit margin, but in this case, revenue increased. So the way to look at this is you're looking at revenue, increases, decreases. You're looking at the net profit margin. You're looking at share buybacks. And that's three main ways that you sort of look at how earnings per share are growing or, subtracting and things like that. So, if you look at, and by the way, all else isn't always equal. So you could have shares being bought back, you could have margins increasing or decreasing, and you can have revenue increasing or decreasing. And it's all those changes that sort of affect the earnings per share. Okay, so one of the things I wanted to sort of just discuss, though, and take a look at, maybe an example. One of the first ones I'll look at is, let's say, Amazon. And I've got some data, and I can link to the site that I used to get this. But I've got data back to 2005. And so if you think about 2005, and they haven't closed out 2019 yet, but I've got through their December 31st, 2018 numbers. So you kind of take a trip back down memory lane, and what you find is back then they had 416,922,786. That's the number of shares outstanding. And by the way, as of the end of last year, they had about 491 million shares outstanding. So they've actually increased their float. All right. So we talked about buybacks, but they've actually increased the shares outstanding. And, one of the questions is with growth and with value was some of these growth companies actually more like value companies, or did the growth companies that were priced sort of higher, did they grow into sort of as they matured, did they fulfill their growth? So just kind of taking a look at a few different things. We talked about that forward PE. So Amazon had about 428, million shares outstanding. At the end of 2005, their PE was roughly 45, right? But what's interesting is their market cap back then was, what was it? About $16 billion. And last year, 2018, they made about $10 billion. So on a forward actual basis, so in 2005, its market cap was trading at a forward 1.6 times 2018 net income. So, you look at Amazon and everybody would look at Amazon as sort of like a growth stock. And it actually turned out that it sort of caught up to its eventual earnings. If you look at on a, so that was about 13, say it was trading at a 13-year forward PE, it was trading at what wound up being 13 years later, actually only 1.6 times its eventual net income. Its 10-year forward was trading, had a market cap of about 25 billion 10 years ago, and its forward sort of PE from there it'd be less than 3. So kind of interesting. I looked at Apple as well, and so Apple was another one that was sort of interesting. And for Apple, they actually closed out their year in September, so we've got the 2019 numbers. One of the things you can see is that their shares outstanding have actually been reduced. And so when you look at Apple Computer, and we can pull them up, and if you look at their, let's just look here, Apple. And what I'm doing is I'm actually going back, and I want to see back when they were, I think this is about 14 years ago, how many shares were outstanding. What you see is at the end of September 2005, they had roughly 5.9 billion shares outstanding. Today, they have about 4.4 billion shares outstanding. But you look at Apple, and so they've obviously bought back shares. And their share counts actually went up and then started to decline starting in 2014 and declined since. But when you look at Apple, so their earnings last year for 2019 were about 55 billion. But you look at their market cap 14 years ago, their market cap was 60 billion. So they were trading a little bit over 1 times forward earnings, 14-year forward earnings. And so in theory, let's say if you had an analyst who said back 14 years ago, hey, I think they're going to have 55 billion in earnings. If your market cap is 60 billion, you would be trading it forward, just a little bit over 1 time. 10 years ago, they were trading a little over 3 times forward realized earnings. So I just bring this up because sometimes it's interesting. You hear the value versus growth. And I remember back in the late 90s, early 2000s, you had a lot of the internet companies that really did, a lot of those didn't have earnings. They didn't have the earnings that some of these companies, and it turned out that they weren't, as valuable maybe on a forward basis. And who knows what's going to happen, going forward from today. But I just thought it was interesting to kind of look at some of these growth companies. And what you see is what people may have thought was a crazy price 10, 15 years ago. It turns out they sort of grew into their earnings. So anyway, all right. So hopefully that was a good explanation of multiples about where the earnings attribution comes from. Little trip down history, looking at just two companies. Who knows what they're going to do going forward? But I found it fascinating to look back and see whether or not some of the multiples people were paying for them, back when they had really high PEs a long time ago, whether they actually grew in. It looks like they did. So, but who knows? And then as you hear the end of the decade, you're going to start to hear all these people come out with predictions. And it would be interesting, maybe if I can find a bunch in 2009 for what the forward returns will be for 2010 through 2019. Maybe it would be kind of fascinating to see how many people were right, how many people were wrong. But here's the thing. I mean, the key for all this is just if you're in the markets and you're investing in the markets, just be hedged, because if we have some sort of a downturn, you've got downside protection. And if the market keeps running, great. You participate in the majority of it or most of it. So anyway, hopefully this was entertaining, and we'll probably be back with another episode or two before the end of the year. And then that will be it. We'll be into 2020. All right. Thanks, everyone. We'll talk to you soon.